You're listening to Uranium Spotlight Podcast, sponsored by PurePoint Uranium Group. If you're following this market closely, you'll want to explore Behind the Curve, Understanding When and How the Uranium Market Turns, a new white paper that shows investors how to spot the cues that come before uranium prices move. And now, your host, Chris Frostad.
It's Tuesday, November 11th, 2025, and this week on Uranium Spotlight, spot prices ease on profit-taking. A potential Niger to Russia shipment tests geopolitics. Hungary broadens its fuel options. The United States elevates uranium on its critical minerals list, and operational momentum from Denison and enCore. The uranium spot price opened last week at $79.13 a pound and closed at Friday at $77.20 a pound U3O8. Trading kicked off with fresh fund buying that included multiple purchases at the end of the prior week and into Monday. Offers softened as the week progressed, taking the daily price down to $78.85 on Monday and $79.65 on Tuesday before sliding again midweek. By Thursday, the indicator marked $77.20, and Friday activity featured both higher and lower prints as liquidity returned ahead of the cutoff, leaving the week settled at $77.20. Across the week, a total of 11 transactions were reported for roughly 900,000 pounds. Buying was led by financial participants early, while utilities stepped in as prices drifted back toward the mid-70s, seeking to top up between recent peaks. Sellers adjusted offers lower to stimulate demand, and some inefficiency remained visible as bids and offers crossed at various levels through Friday. For investors, the key takeaway is that price weakness came from normalization rather than a shift in fundamentals, and liquidity improved into the close as utilities tested the dip. Tightness remains defined by access and timing rather than headline prints, which continues to favor wealth, finance producers, and near-term developers. The trading we're seeing now is one of the cues discussed in Behind the Curve, the white paper that shows investors how to recognize when uranium's real move is about to start. Get it now at uraniumspotlight.com. French security officials indicated that Niger's military rulers may be arranging the sale of about 2.2 million pounds U3O8 mined by Urano before the state seized Amoran and Samar. The reported route runs from Arlit through Burkina Faso to the port of Lome in Togo. French sources called the corridor insecure, while Niger's authorities deny the transfer is happening and argue they would not move sensitive material in that way. Reporting has been conflicting, with suggestions of loading activities offset by local accounts of little movement around the Arlit stockpile. Legal pressure is mounting. Urano has brought a case to the World Bank's arbitration body, and an order has instructed Niger not to sell, transfer, or facilitate transfers of uranium mined at Samar. If the state were to move inventory and be found in breach, proceeds could be clawed back from aid flows, adding financial risk to any covert transaction. Russia's Rosatom has denied involvement. Observers note that Russia does not need these pounds to meet its own fuel obligations, but it may support Niger financially and politically. The friction highlights how state inventory can become a bargaining chip once mines are nationalized, and how sanctions and insurance hurdles fragment what used to be a single global pool of supply. For your investors, this matters because the legal freeze on Samara material and the logistical hazards of any attempted transfer limit near-term availability from a once meaningful supplier, reinforcing segmentation in original acceptable pounds and increasing the value of secure, transparent supply lines. Budapest signed a new fuel arrangement with Westinghouse for its fleet of reactors built to Russian designs. That follows diplomatic backing from the United States from Westinghouse in several recent agreements. Hungary continues to source from Rosatom, but the government is clearly building a second lane for fuel security. The strategic logic is straightforward. A growing set of tenders now requires origin assurances and compliance with sanctions regimes. With the European Union debating measures on Russian nuclear services and fuel, and the United States already restricting imports, countries in the middle are beginning to hedge. Hungary's approach secures optionality on delivery timing, assembly design, and political risk. It also signals to the market that Western fabrication and enrichment capacity expansion will have anchor customers even in places that historically leaned east. There's a commercial read-through as well. Cameco, as part owner of Westinghouse, benefits when the Westinghouse order book expands across both fabrication and supporting services. Multi-year awards lock in throughput and support pricing durability, while the need to qualify Western fuel for Russian-designed reactors creates sticky relationship-driven volumes over a long horizon. For investors, this matters because dual sourcing reduces the probability of disruption for a European buyer and increases the probability that Western fuel cycle assets run near capacity, which supports margins and underpins longer tenor contracting across the front end. The United States placed uranium on its 2025 critical minerals list under the Energy Act framework. Minerals on the list receive policy attention, streamlined pathways, and eligibility for targeted support intended to reduce the risk of supply disruptions. The designation is adaptive and can change with technology and market conditions, but the inclusion of uranium underscores its role in a grid that relies on 90-plus reactors for a large share of clean baseload power. The industry reaction was swift and positive. The move aligns with bipartisan momentum for nuclear power and signals that government agencies will prioritize permitting efficiency, infrastructure support, and strategic stock planning where appropriate. It also complements prior actions that catalyze domestic production, conversion, and enrichment while encouraging utilities to extend coverage and diversify origin away from sanctioned or policy-constrained sources. Importantly, critical status can lubricate interagency cooperation and accelerate approvals for projects that meet environmental and community standards, reducing timeline uncertainty. While it does not set price, it compresses calendar risk, which is often the binding constraint in mine development and fuel cycle investments. For investors, this matters because policy supply reduces non-price risk, which tends to lower the cost of capital for qualified developers and fuel cycle projects. The combination of demand growth and a clearer pathway for domestic supply and services can expand valuation multiples for credible teams with near-term catalysts. Denison Mines reported first production from the McLean North mine using the Sabre method, with about 2,000 tons of high-grade ore mined and about 85,000 pounds produced in the third quarter on a 100% basis. Its share of production was roughly 19,000 pounds. Initial operating cash costs for finished goods averaged about 19 United States dollars per pound. At Wheeler River, permitting advanced with Saskatchewan ministerial approval of the environmental assessment in July and completion of Part 1 of the Federal Commission hearing in October, with a final session scheduled for the week of December 8. Detailed engineering is about 85% complete. First-year scopes are near complete, and procurement is well underway with close to $27 million spent and about $44 million committed. Total cash investments in uranium holdings stood near $720 million after the convertible note financing in August. enCore Energy delivered year-to-date volumes near 480,000 pounds into contracts at an average realized price in the near 60s, with third-quarter extraction of about 227,000 pounds in South Texas. The company delivered 130,000 pounds in the quarter at a realized price of about $68 and carried roughly 287,000 pounds in inventory at a cost of about $38 per pound. Cash and equivalents were about $100 million, and the Dewey Burdock project entered the federal Fast 41 program for expedited permitting review, with the Nuclear Regulatory Commission as lead agency. Management emphasized rising well field efficiency and no planned market purchases in 2025. For investors, the key takeaway is this. Denison is de-risking a Tier 1 ISR build with tangible production at McLean North, advanced permits and a fortified balance sheet ahead of an investment decision, while enCore is demonstrating steady extraction, constructive contract deliveries, and regulatory momentum on a second growth leg. Together, they illustrate why operational progress and balance sheet strength are decisive advantages in a segmented market where timing and assured origin drive value.
Before we wrap up, if you haven't yet read Behind the Curve, Understanding When and How the Uranium Market Turns, it's worth your time. It explains the real signals that reveal when uranium prices are about to move, long before the headlines catch up. Order your Behind the Curve white paper at www.uraniumspotlight.com. You've been listening to Uranium Spotlight, your weekly podcast dedicated to the latest developments shaping the uranium fuel market and its role in the global energy landscape, sponsored by PurePoint Uranium Group. While our passion for this sector is undeniable, remember that nothing discussed here should be taken as investment advice. Our goal is to provide a clear and balanced view of the factors influencing uranium prices. Join us again next Tuesday for Uranium Spotlight.